Hi, I'm Justin Zaks, Vice President of Strategy at Remove Technologies. I'd like to welcome you today to our first webinar of our inaugural three-day virtual event entitled Navigating Market Volatility with a Resilient Portfolio. There's a lot of uncertainty out there right now, and we've put together a diverse program to help steer your portfolio in the right direction. Each day, we're going to be airing 3 webinars, each 40 minutes long with a 10-minute break in between. Friday's webinars start at 1 p.m. Eastern and Saturdays at 10 a.m. Eastern. This event is going to give viewers an exclusive opportunity to learn about a variety of topics, including zero DTE options, ETFs, portfolio building, earnings season, U.S. elections, and how to use the Moomo app, along with many, many more. We'll be talking to a number of experts from SIBO, Wellington Management, BNY, Franklin Templeton, as well as a number of other leading financial professionals. On our first webinar of the day, investment ideas for 2025, trends and themes, what worked in 2024, what might continue to work in 2025, and investing after the election, features Francesco Maino, Vice President and Investment Strategist at Wellington Management. Now that the election is over, many investors are turning their attention to 2025. I'm going to talk to Francesco about what we're hearing from Wellington's clients on the results of the elections, on valuations, the economy, and what the expectations are for the future. If you enjoy this webinar, please check out the live section of the app under the Discover Moo tab to sign up and set a reminder for more of our informative upcoming webinars. Let's dive right in. Welcome from Luxembourg, Francisco. Tell us a little bit about yourself and what you do at Wellington.
Thank you, Justin, and good morning, good afternoon, all your participants. It's great to be here with you guys today. So my role at Wellington essentially as investment specialist is to try to translate some of the complex vernacular about financial jargon to the retail and wealth investors, like trying to bring very concrete different strategies and complexities that portfolio managers have in their portfolios in a streamlined way so that clients can utilize and can understand what we think behind our portfolio management and therefore benefit from that, hopefully.
Yeah, and that's something that here our clients at Moomo are very interested in understanding these portfolio managers and how all their systems work and kind of what they think about things. And so we're going to be talking about a variety of topics today, but I know the number one topic on everyone's mind over the last few weeks has been the U.S. elections. And what has been the reaction to the election so far on both a sector level and overall market level?
Yeah, the market level impact has been positive, right? Like, a little bit expected. Quite frankly, it was not a massive surprise that Trump won election. However, what surprised the market was the advantage that the Republicans had after the election. And so market impulse has been strong, and sectors support has favored mostly growth sectors. And when we see what worked, you think about financials, technology, energy, all sectors where some of that deregulation will probably sort of like play a bigger role in Trump too. The other thing that did work was also sectors that are more cyclical in nature. So you saw consumer discretionary industrials really doing well. We did see a little bit of a catch up from the small and mid cap segment. I think this was a bit of a reminiscence from Trump 1. Obviously, this time around, we had a bit of a playbook. Investors had a bit of a playbook. We knew what to expect. And so I think this first week, 10 days of trades have been focusing mostly on what worked last time around and what investors think might work in the future. And so we saw a lot of flows towards this part of the market, I have to say.
Yeah, that's very interesting. A lot of times investors do look to the past to make moves about the current situation. And so maybe I'll ask you a little bit about that because, the past cannot always be relied upon for future results. And what we saw in terms of where the market was under Trump 1 might be a little bit different now. What might you think is a little bit different and, might have a, slightly different outcome this time?
Yeah, we're in a different situation at this point. First of all, the deficit situation in the US today is much more of an issue than it was back then. And, when you look at what Trump's policies might look like for this 4-year term, they seem relatively aggressive. And we think that might have a lot of implications on the fixed income market, for example, which in turn might also impact equity market down the road. I'm not going to extend, my question. It's a very complicated answer, but I'm just trying to keep it short here. Obviously, market valuations, right? Like the AI push has been tremendous, and S&P is trading at all-time highs. And so not only relative to itself, but relative to the rest of the world, right? And so, we already are in an environment where equities come from a period of strong rally. So, the environment is different. And so we should not 100% rely on what happened in 2016, 17 as necessarily the playbook for 24, 25, sort of speaking. And so a little bit more cautious. I would say, it's not going to be a straight line. That's what I'm trying to say.
Yeah, and that's something else I wanted to ask you about is, we've seen some massive moves sector-wise, and I'm going to give you two that I feel that have moved a lot, and it doesn't mean it's not justified, and that's what I kind of want to ask you. When does some of these moves become unjustified or maybe need a little breather? And that's crypto and financials. We've seen some moves in financials in a day or two that normally would be a year's move in some of these stocks. And I see it affecting financials in a lot of different ways. There's an interest rate shift in the interest rate curve. There's deregulation, and then there's this idea of how far in addition is M&A, right? And so those three buckets. So in terms of financials, do you see certain financials maybe doing better? What has the whole group moved, and some of it's warranted, some of it's unwarranted? Any thoughts on the financials?
Yeah, I mean, we came from a period where at least the smaller cap financials had been sort of like impacted last year in the US quite negatively. So there was a negative sentiment around that cohort, which obviously benefited more from that potential deregulation that President Trump has already announced. And financials is one probably of the sectors that will benefit the most. And so I think the trade is consistent with that. The second derivative, and you mentioned this, is like, inflation expectations might move up again. And so, that should be supportive also for large cap financials, like large cap banks. And so I think the impact is relatively broad-based. Obviously there is idiosyncratic risks and opportunities related to single names and single companies. However, we do see a bit of a positive momentum for the entire group, right? There are some areas that are a bit more growth oriented, some areas that are more defensive oriented. If you split financials, you get a lot of things inside of it, right? As well as the tech part, right? Like all the, Amex, Visa, all the financial payment companies, which have had a tremendous rally really in the last 2 months or so. So all that part did really massive catch up as well. So fintech, right? So, we do see the trend potentially to continue in the short term. But, I haven't touched upon the crypto component yet. That was one of the.
I think that's that's a lot of our customers are interested in that, and particularly interested in what you're seeing from your clients, both retail, institutional, and how they're thinking about crypto as an alternative asset.
Yeah, we've been very, very cautious on this. I think, BlackRock was probably one of the first one sort of democratizing access to Bitcoin or cryptos in that sense. But on the institutional side, I have to say we have seen very, very little movement there and a lot of cautiousness. So I'm probably not the best person to comment on that, just because I don't have a lot of like clients that have benefited from this for the time being, unfortunately. When you look at the movement over the last.
And I think you you bring up a very good point. I think for a lot of people, it's not as widely held as people might believe. There might be a significant concentration of the people that actually own significant Bitcoin. It's not that many people, maybe just several thousand people that own a majority of that, and it's something to consider in terms of liquidity for anyone that's interested in that. And just shifting a little bit, you mentioned a little bit before, and what I really want to get at is that that understanding around the bond market. And I think a lot of our investors are not quite understanding, is higher bond yields good for stocks in this case? When does it become bad? What's the relationship, and how should people be looking at the bond market when making investment decisions in the stock market?
Yeah, I mean, yields obviously have been moving up already for a month now, and I think as the market started to anticipate a likelihood that Trump would win election, his policies are notoriously more inflationary in nature, and so the market has been anticipating some of that. Right now, yields have continued to move up. I think that's also because market was surprised by the majority of votes that Republicans got, both in the House and in the Senate. So there's a lot of the policies that Trump might have as announced that they will be able to do, and so market has been adjusting on that expectation. So to answer to your question, we do not think that U.S. Treasury yield, the 10-year yield, will stop where it is. We do have the expectation that yields goes up even above 5.5%. And even the 6% level is not necessarily anymore something that we're not considering at all, right? Now, the implication of yields moving up significantly in combination of inflation, that is a very bad mix also for equities, right? And so historically, when inflation levels are above 4%, that's a level that typically tends to impact equity investors as well. Let's say until 3.5 companies are able to pass through their customers the higher costs of production. Above that 3.5, 4%, they have harder time. And so yields do reflect partly the inflation component. And obviously central banks might have to react to that environment. And so maybe not cut as much as the market has been expecting, which, was a significant number of cuts. When you roll back 6-7 months ago, the market was expecting the Fed to go down to 2%. That's no longer the case.
Yeah, and obviously it gets very complicated. And just to remind our our viewers here, the Fed is really only in control of very short-term rates. They don't necessarily influence long-term rates, although there is some type of connection between the two at some point. But that's something to look at when we're doing all this evaluation. And so you brought up a lot of complex topics there. And what I really also want to get at, we've talked a little bit about what some sectors that have done very well, but also some of the sectors or the trends that we've seen do pretty well in 2024 that might be at risk because of the U.S. election, and there might be some shifts, and whether that's a protectionism or something else. Can you talk a little bit about what you might want to be lightening up on, or what you see clients saying, well, this is a little bit, this trade now becomes a little riskier due to a shift in the administrations?
Well, I don't think it's riskier, but one I would notice as where, one that has been really, really strong for the last 2 years, which is the tech or more broadly speaking, U.S. growth, right? We don't necessarily think that the short-term environment for tech companies is negative. However, I don't think that the environment is going to be as positive and conducive to massive relative outperformance of that sector relative to the rest of the market, right? We started to see a bit of a rotation happening already, and I think that can continue. And that's essentially on the back of the fact that earnings growth that for tech were so exceptionally for the last, I want to say 18 months, they are starting to abate, and the rest of the market is starting to pick up again. And so, that exceptionalism of extra returns will probably come down a little bit. I think that is one that I would flag it, just because there's a lot of excitement and a lot of those names. Look at Tesla, what it did in the last, 4 or 5 trading sessions post elections. The valuations are really, really high there. I mean, there is excitement, and when there's momentum in those stocks, and you see, flows and trades, sort of drive valuations higher. However, from a fundamental perspective, you have a lot harder time to justify some of those valuations.
Oh, that's a great answer, and I just like to welcome all of our viewers tuning in late. I'm here talking with Francesco from Wellington about the outlook for 2025, and you just mentioned valuations, and that's the next topic I want to get into. Not just for these specific stocks or sectors, but more overall the U.S. market. How does the equity valuations look in the U.S. market on a historical basis? And then I know you're based in Europe. How does it compare to some of these other countries' valuations out in Europe, and how are investors looking at this dichotomy?
Yeah, I mean, valuation is not a good topic supporting, more investment in US stocks. I think, if you had to invest only through that valuation lens, you'd be very worried about, the overall US market. And that's simply because relative to every other region in the world, US equities are trading in the 100th percentile. So they have never been more expensive. And that trend has been there already for a while, the 90th, 95th percentile. Now we're in the 100th percentile. I think it has been justified from, massive earnings, a lot of innovation coming out of the US, a lot of US companies benefiting from it, right? So there is a lot of reasons why this has made sense. I would add as well that compared to, the tech bubble, this is a completely different situation. We don't think this is a bubble at all, despite valuations being so significant. And that's simply because those companies are generating strong revenue growth, strong earnings, margins are at all-time high. And so those valuations are well deserved. The question I think investors will have to ask themselves is, depending on what your investment horizon is, and if your investment horizon is next quarter, valuations don't matter so much. If your investment horizon is 3 year or 5 year, then that valuation piece can become a little bit more cumbersome and difficult to deal with. And so, that's what we see on the institutional side, clients struggling with a little bit.
Yeah, no, I see the same thing here at Mumu among some of the clients that we talk to. The valuations are pretty high, and you have to take that into account. And again, like you said, it's not the same situation. So, just because valuations are high doesn't mean they can't go higher. It doesn't mean they can't grow into them, and it doesn't mean there'll be a crash. But it could. So people are looking at all that,
And so the opposite is also not true. Not because valuations are cheap, that means that necessarily, otherwise China would have been a fantastic trade for the last 2 years. That's not been the case, right? So it is one element. That's why I started with, if valuation is your only lens, that's not a great environment. But obviously, investors cannot utilize only one lens to look at markets. Otherwise, it becomes too simple, and we will be rich, and all our trades will be correct. And there's multiple lenses to look at. And I think what I think makes difference is that the economic backdrop in the US remains really strong, and earnings growth for 2025 are expected to be really, really strong as well, right? So despite the valuations, everything else is still screaming like, that's a good trade for investors.
Yeah, yeah. Obviously, here we're seeing some real profits compared to, the tech boom. It really didn't have it. These were companies that were, had negative earnings, pre-revenue, or in that category, and it's a much different situation now. And speaking of these different lenses, and first, I'd also like to remind our viewers, continue to ask those questions in the chat, and we'll try to get to a few of them in a few minutes for Francesco. But another lens I wanted to ask you about is concentration. Concentration levels seem to be quite extreme. The Magnificent Seven now account for about a third of the S&P 500 market cap, but the equal weight S&P 500 has actually outperformed the market-weighted 500 in the second half so far. Is this a new trend? You expect it to continue? What are your thoughts on concentration? Is the Mag 7 going to eat the market or not?
Well, they already did eat the market in some sense. Look, I think we're counting on, quite frankly, on a wider breadth. I think it's much healthier if there is more breadth in the market rather than the concentration we have seen. This does not mean that individually some of those stocks can continue to perform well. Others will probably struggle a little bit. However, tech has come out from a very weak, maybe with the exception of NVIDIA, a very weak cycle in 2022, right? Like just to put things in perspective, Meta was down, I don't know, 75%. As of maybe I want to say mid-November 22, for that part of the year, for that 11 months of the year almost. And so obviously to climb back to the valuations they had, going up 75% is not enough, right? Like, so the stock had to go up 300%, right? Just to be back at the same level of 2021. So, I think this is something that investors sometimes forget, right? Like, and 2022 was a very weak cycle for some of those tech stocks. So naturally, we have seen it catch up now. Where do we go from here? I think some of the companies will have more sort of like abate sort of like performance. But when you look at the projected earnings growth, albeit being less strong than they have been, they still look very, very, very healthy. So again, in the short term, I think this momentum and the Trump trade, I think, can possibly continue. There's sort of like animal spirit, if you want, that has been reignited, can continue, can have some legs. However, if you extend a little bit your investment horizon, you would expect the market to the rest of the market to catch up a little bit. I mean, valuations are extremely depressed in a lot of areas of the market. So I think why I was surprised in the last 3 to 4 months is that while the other 493 stocks have gone up, most of the Mag 7 group has still managed to do well. So so we haven't seen a complete reverse, a change in leadership there. So that's something I would note. That's infant that I thought would be different.
Yeah, and part of part of that tech trade has been really focused this year on AI, artificial intelligence, perhaps the hottest trend in 2024. And a lot of our viewers are wanting to know, is this going to continue, and why? And should investors expect triple-digit returns every year, particularly next year? And are we going to see a $5 trillion market cap stock, a $10 trillion one? Like, how far can this go? I mean, it's just been phenomenal, right?
Yeah, it's been a phenomenal rally. You're right. I mean, NVIDIA has been, the massive winner behind all of this, right? Like a lot of companies have benefited from, but I think NVIDIA is the key player there. And can this continue? I think so. It can continue. As long as NVIDIA's clients keep investing their capex into artificial intelligence, the trend will continue. However, I would highlight that the bar for expectations is really, really high. And so, all it takes is, some hiccup in operation and those numbers might come in a little bit weaker than expected. And you can see the stock down 20% in 2 sessions, right? So this is not something that clients should discount. So I think that when those situations happen, I think those are good buying opportunities for those that do not have enough. For clients that have enough, they're already benefiting from that. They're enjoying that. And I think, so what we're doing on the institutional side is that most of our managers tend to manage that position plus minus, right? We have so many portfolios, so there is no one rule that fits all, but many of the portfolios that I talk to clients with have been managing that position roughly equal weighted to the benchmark. And so, what happens is that when the stock goes down 15, 20%, we go slightly overweight. And then when that stock rallies back, then we can cut a little back to equal weight. It's been a massive winner, but having confidence that that trend will continue to triple-digit returns next year, I think it's a little bit too much of an expectation. That being said, we mentioned 5 trillion. I think Nvidia is trading at 3.5. I don't see Apple getting to that level anytime soon, but Nvidia, it might. They only need to do another plus 40%, and they will reach that 5 trillion. So I think that can happen. Don't know if in 2025, but there might be a reset of expectations at one point before another leg of growth afterwards.
Yeah, so that's some really great analysis, and that's specific to some of these tech and AI stocks. But we were talking in the green room before about technology generally and AI and how it's improving our work productivity. And so it's actually it's not just these tech companies that are benefiting directly from it. Like, other companies are now using it to enhance productivity. Has this reset the bar on profit margins? We've seen record profit margins for the last few years, and the conventional wisdom has been profit margins are mean reverting. The labor costs will come in line, costs of commodities will rise, there will be inflation that will eventually bring these profit margins back into a line on a market basis. Has AI changed the game on this? Should we expect profit margins to stay at this level or go higher from here, or will there be mean reversions? What are your thoughts on that?
I don't think they will mean revert, but it depends on the industry and depends on the sectors the companies are in, right? Like, if you're in a company that's a very labor intense, take Amazon. If the employees strike because they require higher salaries, chances are you cannot replace all the employees with AI. Right. And so, so it does depend a lot on the sector you're in and the type of companies. Where we have seen record margins high, and we think that can be sustained, is more on the capital light sort of like industries. And so there I think the trend can be sustained. Will they continue to grow at this very high rate? Unlikely. But it's hard to think like a significant mean reversion from here. But a lot is related to cost and inflation, right? Like, so and I think this is one of our points for next year, that while we do like the economic backdrop, I think that inflation piece might be coming up at one point. And so companies will be faced with some of that dilemma of, what to do. Will they have to cut costs? Will they cut investments? Will they, how will they manage and protect their margins, their earnings growth for shareholders? And that's very interesting.
Yeah, and that's again some great analysis. I know I'm looking at the chat now. I see a couple of our users are asking, about the margins. They were asking about the bubble, which you addressed. And now I really want to kind of move in, holistically. What are some of the new trends investors should be aware of going into 2025 that you're seeing from your clients?
Well, one is certainly valuations. We touched upon this, and so I think the market in 2025 will have to come to peace with that component. Like, so that's something I think it's coming at one point. We do expect a little bit of volatility ahead, a little bit of reset of expectations, which, I'm sure investors don't like to hear it, but, can be even healthy. And, historically, it's not uncommon for, S&P to have like a 10-15% sort of like, correction throughout the year before like, companies can recover. So that could be something like relatively healthy that we might deal with in 2025. The second component is growth, right? Like, so we went from an expectation of recession in 2022, with that expectations been pushed out 23, 24. And now, with Trump in power, we think that is pushed even farther out. Fiscal is relatively strong. And so, we think that growth is more likely to surprise on the upside than the downside. And so in an environment where, you have, valuations high, growth surprising on the upside, and inflation potentially shooting up again, driven by some of those very sort of market-friendly policies that Trump wants to bring forward. At the time when the Fed has not fully controlled inflation, yesterday we saw the numbers, and it seems like inflation is stabilizing around 3.5%. We think that the backdrop is for inflation to potentially go up next year. That will not matter much equity markets in the first, I want to say, quarter or 2 quarters for 2025. But, this is something that, I'm pretty sure equity markets will have to deal with later on.
Yeah, and so for the last part of this webinar, I want to get into a little bit more about the economy. So please, users, if you have any questions about the economy for Francisco, please let us know. You kind of talked a little bit about Wellington's outlook for the economy in 2025. I'm just kind of 2 questions. First question is, what is the driver behind this economic outperformance this year and the expected outperformance? You did mention the election. We talked a little bit about AI. Anything else that you feel like is the reason that we're doing better than expected, or are economists just too pessimistic all the time?
No, it's just that we are in an environment where basically, with the exception of Europe, everyone is doing fiscal stimulus, right? And right or wrong, this is what we are seeing, around the globe. It's either fiscal or monetary, and sometimes the combination of both. So, then the backdrop for global growth is expected to improve rather than coming down. So it's more the fiscal discipline that is not there. And so because that's not there, then the expectations on economic growth are looking better. And then, more broadly, you see the earnings, like, I'm not sure I mentioned, no, I don't think I mentioned earlier, but, earnings growth for S&P next year expected to be 13-14%, which, potentially is a little bit too high. The game is going to be that as we come through 2025, the expectations will be reset a little bit down, and then companies will surprise on the upside. That's typically what you will see. And so you'll get almost double, sort of like mid-double-digit earnings growth for 2025. I mean, that's really, really healthy backdrop. And so, we think it could be a very conducive environment to risky assets, a bit less for fixed income, but yeah, more strength on the equity side. Yeah, maybe I'll stop there. Yeah.
Okay, yeah, and so I just maybe want to present a counterpoint. That, I mean, that's obviously kind of your base case, but I'm thinking along the lines of, there are still some fiscal hawks on the Republican side in the Senate, and maybe they aren't able to push through the type of tax cuts that the market is now expecting. If this fiscal craziness does come to a halt, how might a possible recession impact valuations, and what can investors do to protect themselves against a scenario like that, even if it's a minority scenario?
Yeah, even if it's unlikely to happen, I would say, the playbook is 2022. Like we like investors can essentially look back a little bit. 2022 was a different environment again, because inflation at that time was way higher. But typically in a risk-off environment, when you're looking at equities, the sectors that perform the best are the ones that are less sort of like operating in segments, in industries that are more resilient. are less cyclical, and so those typically are, you know, your utilities, your healthcare, your consumer staples. You know, those typically are the areas of the market that one way or another do better in that big sell-off environment. You know, from a style perspective, you know, so you can do from a sector perspective, from a style perspective, you can look at low beta, low volatility, you know, value, you know, so all the parts of the market where valuations matter more, and so valuations are a lot lower than the more growth segment of the market. So those are, you know, those are ways. And then obviously then you have the hedge funds, the options, the futures, you know, like, you know, there is a bunch of like additional instruments that investors can use to protect their portfolio, to hedge the market risk, which is, you know, very, very important as well, right? Again, not a major risk at the moment, but it is something that, you know, a correction along the way, I'm sure it will, you know, will happen in 25.
Yeah, so you know, kind of the next question, and maybe I want to combine a couple. I've gotten a lot of great questions from the users, and I want to ask you about three topics and maybe how they're interrelated. The inflation and inflation outlook, dividend paying stocks, and real estate. How are all these combining together? And I mean, there's a complex relationship between all three of those.
You said dividend outlook and
the dividend outlook, inflation generally, and then real estate. You know, real estate prices continue to go up significantly, yet transactions are at record lows in the light of relatively higher mortgage rates, particularly over the last few weeks. So, you know, obviously we can invest in these REITs. Some of them pay a lot of dividends. How do interest rates affect some of these dividend payers? How's inflation going to affect that? You know, your outlook generally is for, you know, higher inflation and higher interest rates, and kind of want to make sense of how that plays into pricing, the stocks themselves, and just the whole ecosystem.
Yeah, you know, well, thank you. Great questions. You know, look, you know, we have always been of the idea that inflation will hardly go back to 2%, and the Fed will be able to smoothly cut all the way through to that. Obviously, you know, that's, you know, Fed has engineered already a sort of like an environment that has been super good. However, we do think that inflation is gonna stabilize around this level, and some of those policies that are more inflationary in nature might push inflation to go up. And so, you know, if inflation remains at 3.5, and then next year inflation starts to move up again, what we do think is that the Fed might start to react to that. Right now, the Fed is very concentrated on the labor market. So what we expect is that if labor market is very weak, that will give room to the Fed to continue to move towards the 4% rate. If the labor market is much better than expected, then that might even give the Fed a pause. Right now, there is an 80% probability of a rate cut in December. Like 3 months ago, that was a given 100%. Now the probability has been reduced to 80%. And it is if the unemployment data come in a little bit weaker, we think that the Fed might even signal at one point, come in stronger. We think that the Fed might even signal a pause after December. They might do a December cut, but then signal a pause in the first meeting of 25. So all that is super important and plays a massive role into equity valuations. Well, predominantly on the bond side, but that also has implications, as we said at the beginning, also on the equity front. Like on the dividend side, I think, yes, you know, like as long as margins remain relatively good, the economic backdrop is relatively good, and you don't see a big shootout in inflation, I think companies will be able to meet their dividend sort of like thresholds. However, you know, we have started to see some of the dividend payers like changing a little bit their plan. Obviously, for them, managing the capital allocation is very important, And, some of it goes in investment, some of this is eaten by margins and a higher cost, right? So how each company manages this is super, super important. But dividend yield strategies tend to be very value driven. They tend to have a lower beta. So historically, they have worked fantastically well in down markets. Like 2022, some of those portfolios that invest in those companies that were down 10%, the market was down 20-25, right? So that's the way this is connected with the higher yield, higher inflation sort of like environment.
Yeah, great answer. It's quite a complicated topic, and I'm glad you're able to shed some light on that. And I think I could go on for another 40 minutes here. Unfortunately, our time is running kind of short here. Thanks so much for being with us today. Any last thoughts for our audience?
Well, good luck out there. I think it's a tough environment. It's a tough for professionals. So I'm 100% sure it's going to be tough for everyone. There's a lot of decisions to be made. I think the short term, the key message I wanted to give you today is that the environment remains relatively positive for risky assets. We might see some volatility in 2025, but I think that if the economic backdrop remains as positive as we think it will provide opportunities for getting more allocation to risky assets, equities, and so on. So, good luck to you all. Thank you for having me. I appreciate your time.
Thank you so much. I want to thank everyone for tuning in. Make sure to check out the special offers on our website if you're not already a Moomoo user. We'll be back in 10 minutes with our next webinar, Advantages of ETF Portfolios in the Current Financial Market, featuring Matt Camuso, Head of ETF Solutions at BNY Investments. Until then, stay tuned.
Worried a stock's price will go down right after you buy it? With Moomoo, you can check out the most updated short sale analysis before you trade. Find out how much a stock is being shorted and its short sale trend. Get a clearer understanding of the market and trade with greater confidence. Short sale analysis is free and exclusive on Moomoo. Download Moomoo now.
Too much research, too little time? What if you move smart? Invest smarter with Moomoo. Small gains, big efforts. What if you move smart? Invest smarter with Moomoo.
Everyone around me is talking about investing. Do you invest too?
Moomoo.
There's so much research to do, but so little time.
Moomoo.
But how do I actually start?
Download Moomoo!
Investing made easier. Download Moomoo now.
Moomoo has partnered with derivatives world leader SIBO, bringing you an options experience like never before. 5 major index options are now available to trade on Moomoo. Enjoy competitive pricing with zero commission, as well as zero contract fees for stock options. Inform your strategies with Moomoo's suite of free options features, including as many as 13 option strategies for you to choose, with their theoretical profit and loss analysis quickly revealed, as well as in-depth options chain, among many others. Experience pro-level tools by downloading Moomoo now.
Hello, Japan.
Hindsight sucks. It's all about foresight. When it comes to trading, you gotta get your calls right. Moomoo's the platform with AI intelligence, serving up insights based on customized relevance. Globally backed around the clock support. Pro-level features at a cost of naught. So let me ask you some questions that may seem curly. Would you rather work from dawn or retire early? Dream of getting on the ladder or buy a dream home, dance to someone else's tune? Or Moomoo your own?
Worried a stock's price will go down right after you buy it? With Moomoo, you can check out the most updated short sale analysis before you trade. Find out how much a stock is being shorted and its short sale trend. Get a clearer understanding of the market and trade with greater confidence. Short sale analysis is free and exclusive on Moomoo. Download Moomoo now.
Too much research, too little time? What if you move smart? Invest smarter with Moomoo. Small gains, big efforts. What if you move smart? Invest smarter with Moomoo.
Everyone around me is talking about investing. Do you invest too?
Moo.
There's so much research to do, but so little time. But how do I actually start?
Download Mumu! Investing made easier. Download Mumu now.
Mumu has partnered with derivatives world leader SIBO, bringing you an options experience like never before. 5 major index options are now available to trade on Mumu. Enjoy competitive pricing with zero commission, as well as zero contract fees for stock options. Inform your strategies with Mumu's suite of free options features, including as many as 13 option strategies for you to choose, with their theoretical profit and loss analysis quickly revealed, as well as in-depth options chain, among many others. Experience pro-level tools by downloading Mumu now.
Hello, Japan.
Hindsight sucks. It's all about foresight. When it comes to trading, you gotta get your calls right. Moomoo's the platform with AI intelligence, serving up insights based on customized relevance. Globally backed round-the-clock support. Pro-level features at a cost of naught. So let me ask you some questions that may seem curly. Would you rather work from dawn or retire early? Dream of getting on the ladder or buy a dream home, dance to someone else's tune? Or Mumu your own?